Welcome to the deep dive. We've got this really interesting source material here, basically a deep analysis of the Hershey company, HSY.
Yep, a business quality memorandum. Treats it all as fact for the sake of analysis.
Right. And our job today is to kind of unpack this, figure out what makes Hershey tick, why someone might call it a wonderful company, and most importantly, pull out the key takeaways so you can feel properly informed about it.
Exactly. It's way more than just chocolate bars, right? This analysis goes into how it's woven into the culture, but also its surprising business strengths and, potential risks, too. It's quite the enduring company.
Okay, let's get into it then. The analysis kicks off with the core business. Says it's fundamentally simple, but also, incredibly durable. What's the essence there?
Well, at its core, it's pretty straightforward. They make and sell affordable treats people enjoy, mostly candy, confectionery, but they're pushing more into salty snacks now, too, globally.
And how does the money flow, mostly?
Primarily selling through retailers, supermarkets, convenience stores, the big mass merchandisers. There's also a bit from licensing those famous names and some direct sales to consumers, but that's smaller.
The source breaks it down into segments, right? Three of them.
That's right. You've got North America Confectionary, that's the big, mature core business, generates most of the profit.
Okay.
Then North America Salty Snacks, the analysis points to this as a key strategic growth area.
Ah, the new push.
Exactly. And then International, which is also about strategic growth, but it's a smaller piece of the pie currently.
So what makes this simple model so durable? Why does the source say it's easy to grasp?
Well, it taps into something really basic, doesn't it? That human desire for a little affordable treat, an indulgence. It's not like tech that changes every 6 months.
Right. No obsolescence risk like a software company.
No, precisely. This craving for a Hershey bar or Reese's. The analysis argues it's pretty timeless, not really cyclical in the same way. And those brands, they're iconic. They're tied into holidays, traditions, s'mores. It creates this really deep nostalgic connection for people.
So that simplicity, it's almost a form of risk reduction.
Yeah, the analysis frames it that way. Less worry about some disruptive technology wiping you out. It means, when you're analyzing the company, you focus more on things like how well they run the plants, manage the brands, spend their money, valuation. And critically, it makes predicting those long-term cash flows a bit easier. The source really highlights that as a feature of these wonderful companies.
Okay, simple, durable foundation. Makes sense. Now, how does it fend off competitors? The analysis uses that term economic moat. It says Hershey's is wide and durable, like a fortress. What's it built from?
Two main things, according to this memo. Intangible assets, basically their brands and sheer scale.
Let's start with the brands.
Okay, so they have over 90 brand names. Many are iconic. Hershey's itself, Reese's. The analysis calls those two colossi in the candy world. Think about it. That's over a century of building loyalty, getting space in people's minds. Mental shelf space is the term used.
And what advantage does that give them, that mental shelf space?
It means when they launch something new, like, say, those Reese's-filled pretzels, people already know and trust the Reese's name.
Ah, so it has a higher chance of succeeding right out of the gate.
Much higher. Compared to some unknown company launching a similar thing. You can't just replicate 100 years of brand loyalty overnight. It's a huge barrier.
Makes sense. And the second part? Scale.
Yeah, scale advantages. They've got 7 huge manufacturing plants just in North America. And their marketing budget, over $500 million a year.
Wow.
Yeah. Smaller companies just can't match that kind of spending power or production efficiency. And the size, it also makes them what the analysis calls an indispensable partner for retailers.
Indispensable? How so?
Well, look at their market share. They dominate U.S. chocolate, 36% share, way ahead of anyone else. And across all U.S. confectionery, it's over 24%.
So the big stores have to carry them?
Pretty much. Think Walmart, Target, Kroger. If they suddenly stop stocking Reese's cups, they genuinely risk losing shoppers who came in just for that. They might lose the whole basket. So Hershey has real leverage there.
Is there any recent proof of this moat working? Does the analysis point to anything specific?
Yes, absolutely. Pricing power. That's the big one mentioned. You know how commodity costs, especially cocoa, have spiked recently?
Yeah, it's been all over the news.
Well, Hershey was able to raise prices significantly to offset that. And the analysis notes that there's a bit of a drop in volume. Some people bought less. But the net effect on revenue is actually positive.
So people paid the higher price.
Enough people did, yeah. It shows that strong loyalty. People weren't willing to give up their Hershey's or Reese's easily.
So how's the moat doing overall? Is it getting stronger, weaker?
The analysis suggests stable to widening. The core candy moat, based on those mega brands, is seen as very stable, very strong. But the overall company moat might actually be widening because of management's strategy.
Which is?
They're basically using the huge cash flows from the chocolate fortress to build a second fortress in salty snacks.
Ah, right, the acquisitions. Skinny Pop, Dots Pretzels.
Exactly. Skinny Pop, Dots, Lesser Evil more recently. The idea is to use Hershey's existing distribution power and marketing muscle to grow these brands in faster-growing categories next door to candy.
Does that make sense strategically? Is the snacks moat as strong?
That's a key question, right?
Yeah.
The analysis seems to view it positively so far. It diversifies their revenue so they're not just reliant on chocolate. And it makes them even more important to retailers. You can get your candy and your popcorn and your pretzels from one giant supplier.
So one-stop snacking shop for retailers?
Kinda, yeah. Their stated goal is to be the number 2 player in all of U.S. snacking, period, building on being number 1 in candy. The analysis sees this as smart execution, making the whole company stronger, not, diluting the core.
And that distribution network you mentioned, that sounds like a barrier in itself.
Oh, definitely. The analysis calls it nearly impenetrable. Over 85,000 retail locations in the U.S. carry their stuff.
Wow.
It creates this loop, right? People want the products, so stores have to give them good shelf space. Good shelf space means they're easy to find and buy, which keeps them popular. It's tough for a new guy to break into that cycle.
Okay, simple business, strong moat, maybe getting stronger. What about the softer side, the scuttlebutt section in the analysis, customers, employees? What did that find?
Well, for customers in North America, it's overwhelmingly positive. The source cites really high ratings, like 4.7 out of 5, on their own website and Walmart's. Recommendation rates are huge, like 96%.
And net promoter score?
Strong. Plus 34. That measures loyalty, willingness to recommend. Anything over 0 is good, over 50 is excellent, so plus 34 is solid. And ahead of Mars and Nestle, according to this.
What themes come up from customers?
A lot of nostalgia, comfort, consistency, things like it's a family tradition or it tastes just like I remember.
Familiarity, right. But didn't the emphasis mention something unusual about the taste, especially outside the U.S.?
Ah, yes. This was fascinating. There's apparently a noticeable group, often non-Americans, who really don't like the standard Hershey's chocolate taste.
Don't like it how?
They use words like sour, even vomit-like comes up in some critiques mentioned.
Seriously, vomit-like. Why?
It's apparently due to butyric acid. It's a byproduct from the specific milk preservation process Milton Hershey used way back when.
Okay, that sounds pretty bad. Surely that's a weakness for a global brand.
You'd think so. But here's the really interesting twist, this sort of second-level thinking in the analysis. For millions upon millions of Americans, that specific taste is what they expect chocolate to taste like.
It's the standard.
It is the standard. It's tied to their childhood, s'mores around the campfire, Halloween candy. So while a European might find it odd, or a food scientist might point out the butyric acid, for the core U.S. consumer, it's just Knita.
So a technical flaw becomes a competitive advantage in its home market.
Paradoxically, yes. A better tasting, smoother European chocolate might just taste wrong to an American wanting that classic Hershey's experience. It's an unconventional defense mechanism.
Huh. Never thought of it that way. Okay, what about the employees? How do they feel?
Generally pretty good, seems like. They're certified as a great place to work.
Sure.
68% of employees rate them that way, which the source notes is better than the average company at 57%. And sites like Comparably show like 82% positive reviews.
What are the positives they mention?
Feeling welcome, good flexibility, pride in the company. Those seem to be common themes.
Any negatives, any criticisms surface?
Yeah, one thing did come up repeatedly in the feedback mentioned. A sense of disconnect between the corporate leadership and the folks on the front lines, the hourly workers, described as a Grand Canyon of distance.
That sounds potentially problematic.
The analysis flags it as a potential long-term risk, yeah. Something to keep an eye on culturally. But it doesn't seem to view it as like a major operational threat right now.
Right, so great brands, strong defenses, mostly happy customers and staff, despite that weird taste thing and some internal disconnects. Let's pivot to management and money. How's the company run? Financial resilience.
Leadership gets pretty good marks in the analysis. Michelle Buck, CEO since 2017, chair since 2019. She's retiring by mid-2026, but the source mentions a smooth transition is planned.
And her philosophy, how is it described?
Clear, rational, very long-term focused. An owner-oriented mindset is the phrase used, which you apparently see in her shareholder letters and stuff.
And the vision.
Transforming Hershey into that broader snacking powerhouse. There's also a stated commitment to long-term value for all stakeholders, not just shareholders, including ESG stuff like sourcing cocoa responsibly, environmental, social, governance factors, and things like efficiency programs show they're acting on it.
How about how they spend money? Capital allocation. Does the analysis like their track record?
Likes it a lot. Calls it exemplary, actually. Very disciplined and strategic. They put serious money back into the core business planning, over $425 million, maybe $450 million in capital spending for 2025, plus over $200 million a year on R&D.
And those acquisitions we talked about, Dots, Skinny Pop?
Viewed as logical bolt-on deals, not just empire building for the sake of it, but moves that directly support that snacking strategy, entering nearby, faster-growing categories where Hershey's strengths can help.
How about returns to shareholders? Dividends, buybacks?
Also gets high marks. Paid dividends for 55 years straight. That's incredible consistency.
55 years. Wow.
And they've been growing that dividend nicely, too, around 13% average annual growth over the last 5 years. Plus, they consistently buy back shares. But there's a really unique factor here the analysis stresses, that ownership structure. The Milton Hershey School Trust. They control about 80% of the voting power.
Right. Why is that so important?
Well, the trust is a charity. Its whole mission depends on getting reliable, growing dividends from Hershey forever, basically. It has this perpetual need for cash flow.
So it creates alignment.
Massive alignment.
Yeah.
Management answers to a majority owner whose time horizon is infinite and who absolutely needs prudent, steady performance. The analysis sees this as a huge structural advantage, a guardrail against management taking crazy risks or chasing short-term fads that could destroy value.
That's a powerful dynamic. Okay, so leadership seems sound, structure aligns interests. What about the numbers? Is it financially strong, a financial fortress?
Definitely the view in this analysis. Terms like earnings machine, superb business economics are used. It points to the steady climb in sales, profits. For 2024, sales hit $11.2 billion, net income $2.2 billion. Just keeps churning out cash.
Are there specific financial ratios the analysis highlights to back that up?
Yeah, two big ones. First is ROIC, return on invested capital.
And how's Hershey's ROIC?
Consistently excellent, above 20%, averaging over 22% for the last 5 years.
Why is that significant? What does a 20% plus ROIC tell you?
The analysis explains it's way, way higher than their cost of capital, which they estimate around 4.9%. It's called the quantitative signature of a strong moat. Basically, it shows they earn very high returns on the money they invest back into the business, something competitors protected by weaker moats can't do.
Okay, high returns on capital. What's the second ratio?
Free cash flow conversion. FCF conversions averaged about 97% over the past 5 years, meaning the profits they report on paper are actually turning into real cash. They're not getting eaten up by huge ongoing capital spending needs just to stand still. This gives them loads of flexibility money for reinvesting, doing deals, paying dividends, buying back stock, high-quality earnings.
And the balance sheet, debt levels.
Managed carefully. Net debt to EBITDA, that's a common leverage measure, is around 1.8 times for 2024. Their target is 1.5 to 2.0x.
So comfortably within target.
Right. The analysis does note it might tick up a bit in 2025, maybe mid-twos, because of acquisitions and those high cocoa costs, but still seen as a conservative, safe level that gives them room to maneuver.
Okay, so summing up, high-quality business, strong defenses, good leadership, uniquely incentivized, fortress financials, which leads to the big question. Price versus value. Is this wonderful company trading at a fair price right now?
The analysis suggests, yes, it's probably fair value, maybe even slightly attractive for a long-term perspective right now.
Why now specifically? What makes it attractive compared to usual?
Well, the valuation multiples are lower than they have been historically. The PE ratio, price to earnings, is around 20 or 21 times now. Its 5-year average is more like 24 or 25.
Right.
Same story with price to free cash flow, currently about 24x, below its recent average of over 25x.
And the reason for this discount, according to the source?
It's the market being very focused on the short term, specifically the squeeze on profits expected in 2025 because of those crazy high cocoa prices. It's a major headwind, no doubt about it.
So the opportunity is?
The opportunity, as framed in the analysis, is for investors thinking long-term, like decades, not quarters. You potentially get to buy this really high-quality company while it's facing a temporary, even severe, problem in its main input cost. The current price might be fair for today's situation, but there's potential for that valuation multiple to rise again once the cocoa situation normalizes and people see the benefits of the snacking strategy playing out.
Right, that snacking strategy. The analysis flags that as the main engine for future growth, doesn't it?
Yes, absolutely. Executing that snacking powerhouse vision successfully, it involves several things. Pushing growth in those acquired brands like Dots and Skinny Pop, which are apparently already doing well.
Okay.
Also trying to capture more health-conscious consumers, like with the Lesser Evil deal, and bringing out more plant-based or zero-sugar options.
Mm-hmm.
And just cleverly using their existing big brands in new ways, like those Reese's Filled Pretzels, which seem to be a hit. It's a multi-pronged approach.
But growth always comes with risk. What are the big, potentially permanent, long-term risks the analysis highlights?
Okay, number one is a fundamental permanent shift in what consumers want. Like a massive move away from indulgent treats towards health and wellness, happening faster than Hershey can adapt.
Is there anything specific driving that fear?
Yes. The analysis explicitly mentions the rise of those new GLP-1 weight loss drugs. The thinking is, these could actually change eating habits on a population level in the long run. Fewer cravings for snacks and sweets. That's a big unknown.
Definitely one to watch. What's the second major risk?
It's about cocoa again, but more permanent this time. There's a non-zero chance, the analysis argues, of a permanent breakdown in the cocoa supply chain.
Permanent. How?
Climate change hitting yields, new crop diseases, political instability in West Africa, where most cocoa comes from. If supply gets permanently damaged, the whole economics of mass market chocolate could just break.
That would be huge. And the third risk, tied to the growth strategy.
Yeah, basically the risk that the M&A fails, that the snacking pivot turns into diversification. Meaning they spend billions buying these companies, but they can't integrate them well, or the synergies don't happen, or they just aren't as profitable as expected. So instead of strengthening the company, they end up diluting the quality of the core chocolate business, wasting capital.
Okay, that sets up this idea of first level versus second level thinking that the analysis brings in. How does that apply here?
Right. So first level thinking, the market consensus right now is pretty simple, according to the analysis. Cocoa costs are sky high. That means lower profits, so the stock price should be lower. It's focused on this immediate cyclical problem.
Makes sense on the surface. What's the second level take?
The second level thinking looks deeper, focuses on the nature and duration of the strengths versus the problems. The analysis argues that the market is so fixated on the temporary cocoa issue that it's undervaluing a potentially permanent structural improvement. The diversification into snacks.
Why are snack earnings seen as higher quality?
Because the cost for things like popcorn, pretzels, potatoes, they don't swing wildly like cocoa does. They're not correlated.
Right.
So a dollar earned from the salty snacks division is seen as inherently less volatile, more predictable than a dollar earned from chocolate, especially right now.
So the market lumps it all together.
Exactly. The second level view here is that the market is punishing the whole company for a problem, mainly in one part of it. And it's missing the fact that management is busy building this second independent profit engine in snacks, making the entire company more resilient over the long haul.
Interesting.
So from that perspective, the current cocoa crisis, while painful, creates this window, a chance to buy this arguably better, more diversified future version of Hershey at a price depressed by the problems of its past.
Okay, let's wrap this up for you, the listener. Quick summary of the bull case, the reasons to be positive based on this analysis.
Sure. You've got iconic brands, a really durable business model giving them pricing power. Management seems rational, focused long-term, and that trust ownership provides unique alignment. The financials are rock-solid great returns, strong cash flow, sensible debt, and maybe, just maybe, the current price is attractive because of a temporary issue.
And the bear case. The main risks and counter-arguments.
Well, maybe cocoa isn't temporary. Maybe it's the start of a permanent problem for chocolate. Maybe the health trend, boosted by those weight loss drugs, really does crush demand for treats. Maybe the snack acquisitions are a mistake diversification into tougher markets where Hershey doesn't have the same edge, ultimately hurting the business. And maybe the price isn't cheap at all. Maybe it just reflects these new, tougher realities.
That lays out the key tensions. Now for that final takeaway, the red team challenge. The provocative question the analysis itself encourages you to ask.
Right. This is about challenging the core assumption. The whole positive case leans heavily on the idea that these new snack businesses will be just as good, just as profitable, just as protected by a moat as the original chocolate business.
So the challenge is that really true?
Exactly. Does Hershey truly have the same kind of competitive advantage in popcorn or pretzels that it built over a century in chocolate?
Is diversifying actually weakening the overall moat? Trading a truly wonderful business for maybe just a collection of good ones?
That's the heart of it. And the follow-up question: could the intense focus on the cocoa crisis right now actually be distracting everyone, maybe even management, from this potentially more fundamental strategic risk, the risk of moat dilution?
Is the cyclical problem masking a structural one?
That's the critical question the analysis leaves you with, something to really chew on beyond the immediate headlines about cocoa prices.
Really forces you to think about the long game. Well, this has been incredibly insightful. Thanks for walking us through this deep dive based on the source material you brought. Hopefully this gives everyone listening a much clearer picture of the Hershey Company.
My pleasure. Always fascinating to dig into the details of a business like this. Lots to consider.